Well, markets pretty flat today after the Fed decided yesterday to hold interest rates pat. But our guest says elevated volatility, price swings is going to be the new norm under Trump. Let's bring in Justin Elliot, portfolio manager at Caldwell Investment Management. Justin, great to see you. So it seems like the White House is going to be driving, well, certainly the headlines and possibly the direction of the market over the next while.
Yeah, I think you're right there. I think I wasn't on too long ago and we spoke to kind of elevated volatility. We think we've continued to see that play out here, and that could just be the new norm under Trump. We know he tends to flip-flop around quite a bit. One thing that's interesting this year so far is the rotation that we've seen in the market. So we've seen low volatility, we've seen high dividend yield, and we've seen those factors outperform. And then you've seen areas like momentum, growth, small cap underperform. So there's this rotation going on into more defensive sectors, which we think can play out here. Just given kind of the lower growth outlook, we had that confirmed yesterday from the Fed meeting. And again, the kind of pullback in business and consumer sentiment as a result of a lot of these tariffs here.
So you are looking for, we're going to get some stock ideas for you, but in general, you're looking for low-cost companies that are leaders in their industries?
Yeah, that's true. That's kind of how we approach things. One thing to note with this defensive shift is part of that is just driven by kind of indiscriminate buying from ETFs, right? As you move into these consumer staples, ETFs or other defensive sectors, we think it's important to step back and be a little bit more selective, and we want to go for those low-cost leaders, those companies that are really providing strong value to their customers, that can drive that stickiness over time, drive that repeat buy from customers. And we're also looking for companies as well that have shown a track record of managing their margins well through inflationary times. And we tend to find that in some of the lower cost leaders, right? They're better at kind of managing their cost structure. And so that's really where we're focusing a lot of our time, and we have shifted a little more defensive in the last little while.
You have some ideas for us. CBOE, the company, the stock of the company that actually runs that Chicago exchange. What attracts you here?
Yeah, so they're one of the leading U.S. financial exchanges. They primarily focus on U.S. equities, U.S. index options and futures. And they've got a really broad range of products that cater to all levels of investor sophistication. But what we really like about them is the innovation that's gone on over the last couple of years, and really trying to target the lower end of the market, sort of that retail investor, that high net worth individual that is more self-managing their portfolio. And so they've introduced a lot of miniaturized contracts on the S&P 500, on the VIX, for example, that's seen really strong uptake in the market, not only from those customers which they were initially targeting, but also larger institutional customers that can see a more fine-tuned approach to hedging. And so we think that elevated demand for those products is definitely going to be here to stay for the next little while. And again, they really benefit from a pickup in volatility in the markets that we're seeing. So you kind of combine those two factors along with some strong expense management that we've seen historically, and we really like the stock.
And that's interesting. Just tell us a bit more about these mini contracts. People can buy into them with less money?
That's exactly what it is, right? You don't need as much capital to invest and hedge with these products. 0-day to expiration options as well that kind of expire on the same day. So when people are trying to hedge intraday moves, or they're just looking for really short-term options, that's another product there that allows you to do that. But the bulk of it, the gist of it is, yeah, we have less capital, and that allows you to trade those products a little bit more.
The Amazon is facing a challenge from Chinese online retailers, including Temu, but you like the look of Amazon stock.
We do. And we've seen an inflection in their retail margins over the last couple of quarters. It's been driven by a couple of things. So one is we think they've made a lot of strides in really getting to those personal care products, right? The healthcare products that people tend to buy on repeat. And so that drives customer stickiness. It drives people to the platform more often. And once you're there, you tend to throw a couple extra things in your cart. And so that's driven, or at least helped drive, some of the margin expansion that we've seen, but they've also invested in getting their distribution network to be a little bit more efficient. They've invested in automation, and the international segment doesn't quite look like North America as far as a margin outlook, but things are improving there rapidly. So, we think they've done a good job to really capture those customers. To speak on your point of, Temu's and the Sheins and those Chinese companies, a lot of the reason why those have taken off is it's called a de minimis exemption. So orders under $800 were able to come into the US basically duty free. And that allowed a lot of these cheaper goods from Chinese retailers to kind of flood the market and take share. That's now been eliminated. And so we see that as beneficial for a company like Amazon that really has the network in place to, benefit from that going forward.
And your final idea, Costco, something of a cult retailer among its fans.
Exactly. Costco is kind of the poster child of a company that's providing value to its customers, right? That's kind of their core business. We want to invest the margin that we make back into our business, make our product line up better for customers. We want to provide them more value. And so when we look at Costco over the last little while, we've seen extremely strong retention. We've seen extremely strong membership renewals despite a price increase, which to us tells us that value proposition is really, really shining through. But what's interesting for Costco is, again, when they have benefited from these results, they've invested back into the business in terms of delivery and their e-commerce operations. So they're also trying to get into the space of being able to deliver groceries kind of same day or if not next day, as well as many other goods that you might buy from Costco. So if you don't necessarily want to make the trip to the store, you can still get the value and the convenience of sort of shopping from home there. But again, that margin performance that we've seen over the last little while, those strong traffic numbers, the renewals and the retention, we like the way that looks into a potentially softer economic environment.
Justin, thanks very much indeed.
Thanks for having me.
Justin Elliot, portfolio